What's going on, Eagle investors? This is Samuel here with another episode of Trade Idea of the Week. Today we'll be looking at a long General Motors position, specifically the 1217 62.5 70 debit call spread. So in this, we'll be buying the 62.5 call for December 17th, and we'll be selling the 1217 $70 call. And what this does is it limits our upside potential, but it also makes for a lesser premium and a cheaper contract price or trade position. So why would we want to put on such a position? General Motors has rallied the past 2 months with the auto space and EV vision slowly showing in investor sentiment. Now we've seen a lot of euphoria and hype around the EV space, and with GM's plans to drastically increase their investment and output of these electric vehicle positions in the future, as the market is forward looking, GM investors are pricing that in a little bit as we continue. Now, that said, if you compare traditional automakers like GM and where Ford used to be trading at compared to your EV space like Tesla, Lucid, and the whole bunch, there's a wide disconnect between the premiums and the general sentiment within those two spaces. Now, as GM continues this investment and actually is able to potentially take market share in the EV space, or at least the perception is that they're able to do that in the future, there should be some convergence between these multiples. So GM is also highly correlated with Ford, at least on historic standards. And this correlation up and down, usually when they diverge, comes back together. There's like a reversion to the mean, and that's very typical. Now, what's very interesting is the last month, there's been a wide divergence between the prices of Ford and General Motors, with Ford outperforming. Now, one might be saying, if Ford's outperforming, maybe I should just buy Ford. But when there's a divergence between two correlated pairs, you should really do the opposite and buy the underperforming one with that expectation of future outperformance. Now, when's that future outperformance going to come? It might not come in the next 31 days, but looking at the upside and where Ford has gone, I think that there's a strong case that it will. So as GM may continue this run sharply to the upside, a wide debit call spread does look favorable. And this spread, the 62.570, has a probability of profit of 40% and potential return of 240%. Now, why would we do a debit call spread? Again, it's very wide, so we're still able to capitalize on it and get multiple returns in the over 200%. That said, just going with long calls can be more risky, especially on a high implied volatility underlying such as GM right now, especially on historic standards. Now, as I mentioned, though, GM and Ford are usually pretty correlated, but they have diverged since September. So in September, we saw a huge move up on Ford, going from around $12 to over $20 a share. Now, GM, however, was in the upper 40s and has since recovered to 62 range. Again, not all-time highs like Ford has, because both of these were rallying as well in June, July, in those months. So what we see here is the investor sentiment around Ford, and sure, there's been some different catalysts, but GM has a lot of the same catalysts and longer term views in the EV space that Ford has. Which one will do better in that space in a few years? Only time will tell. But this short-term divergence is likely to come to an end. And we've really seen that the last few days. GM has been spiking back up, broke that $60 handle where it was in that range-bound range for quite some time. So this is definitely something to keep on watch. Now, target upside management plan for this position, we'd be targeting over 50% of the max potential gain of 240%, so around 120% gain, to allow for capturing of this before expiration. Now, we don't know if Ford's going to come crashing down, or if GM, if it continues up, will it keep continuing? So what this would do is it would allow for us not to just hold out until expiration in the event that GM sees the sharp rally in the next week, we want to be able to get out of that position with a targeted plan. And doing so, targeting 50% of the max gain is a very reasonable estimation if that does play out as expected. Now, if General Motors fades below the $60 level and volatility comes in a little bit, exiting would be the most ideal case scenario to minimize a loss, as the underlying trade thesis for at least this time does not play out. We should exit accordingly. So in summary, going for a long strategy on General Motors provides a strong risk reward with clear continued upside potential. Now the 1217 debit call spread, the 62.570 strikes, does look favorable and can be managed at 50% max potential profit for a sizable 120+% return. And that's around 60% probability of profit to reach 50% of the profit. I hope you enjoyed this video. Please like and subscribe. If you haven't already, make sure to join our trading community in the description below. Thank you.